This brief special presentation is specifically for members of CalPERS who are facing rate increases on their long-term care insurance policies. We'll look at options and some current costs so that you can compare and make an educated decision about your options. This is Jesse Sloan, Executive Director of the American Association for Long-Term Care Insurance. We're a national trade organization. We don't sell insurance, but we help educate the public, and we deal with consumer inquiries every day. And increasingly, we're getting calls from the 150,000 members of the CalPERS Long-Term Care Program. That's why I'm recording this special presentation. In October 2012, the CalPERS board voted that all members who have lifetime coverage and built-in inflation option and have policies that they purchased between 1995 and 2004 are going to face increased costs for their long-term care insurance coverage. We estimate that means about 60,000 of you will have received written notification that your prices are going up. So first of all, we want you to sit back and relax because it's not something that's immediate. And while nobody likes paying more for anything, we certainly understand that, there's some explanations and some reasons why. And most importantly, you have choices. You have the opportunity to adjust your coverage and avoid paying anything. First of all, so the increases are going to come in staged amounts. First, there'll be some smaller 5% increases. The big increase starts in 2015, so you don't need to panic. That one will be as much as 85%, and it will be spread over 2 years. The primary reason for these increases, as we understand it, is two things. The first is CalPERS is seeing increased utilization of the policy. More people are going on claim. That means they're using what they bought and what you bought, and the costs are going up for those claims. And increasingly, because interest rates have dropped, entities are unable to derive the income that they need to anticipate paying future claims. So that's the primary reason that you're seeing a request for rate increases. Okay, this is the most important slide where I'm going to spend a little bit of time. Here are our recommendations. The first thing is review your schedule of benefits. That's the policy that you bought, that you purchased several years ago. And again, if you're getting the 85% increase in costs, that's because you purchased lifetime protection with 5% compound inflation. I will tell you, those policy features are rarely even available today for a couple of reasons. They're just too expensive. That's number one. And as you look at that, you're going to see what your policy benefit amount has grown to today. Then step two is evaluate your benefit needs. At the time that you bought it, when lifetime coverage was affordable and 5% compound inflation growth was affordable, that's what you chose. But today, you may look, if you bought it at age 55, maybe today you're age 65, and you're now retired. And yes, you're on a fixed income, so you want to control your costs, but you're also receiving Social Security, a pension, and maybe your approach to long-term care insurance now shouldn't be to pay every single dollar of potential claim cost, but use it to pay some of the dollars. If you need the care, some of the dollars you're going to pay from your savings, your retirement, your pension, and some of the dollars are going to come from insurance. Evaluate your current and your expected future benefit needs. And then lastly, review the available options that CalPERS sent you. If you look at the letter and the rates that they're talking about, you may determine that you no longer need lifetime coverage. It's very nice if you can afford it, but most people rarely have claims that run that long. You know, we're going to show you in a second an illustration of what $547,000 of benefits will cover. And if you're single, that's several years of coverage. And if you spread it out over a period of time and augment it with your savings and your pension and your Social Security, that might just be enough. Again, some coverage is always better than nothing. And the inflation option, Well, I will tell you, I remember the days when we used to get 5, 6, 7% on CDs in the banks. You can't get that anymore, and that's partially because not only are interest rates down, but inflation is down. So you may look and say, I'm going to lock my coverage at where it is and not have it grow for the future the way it used to. And thereby, you keep your premium costs down. Those are all very viable and I would say even smart options. Does it pay to drop the CalPERS coverage and apply for new coverage? I'm going to tell you in almost 99.999% of the situations that we've seen, it does not pay to drop your CalPERS coverage. First of all, you're going to lose everything that you've paid for. But I'm going to show you in a second why it doesn't pay to even consider taking the time to apply for new coverage, as angry as you might be. So first of all, if you recall, when you applied for long-term care insurance, one of the key factors in qualifying is your health. So if you were to apply for new coverage today, you would have to meet health qualifications. And I will tell you that not only are rates have premium costs increased for long-term care insurance, the likelihood of health qualifying has decreased. Insurance companies are much more stringent in looking at health records. In fact, some are even starting to draw blood because they're feeling that the doctor's records are not as accurate as they need them to be to find out who really is a good viable risk. So that's number one. But just so that you can compare, because this is the number one thing that people ask when they call the association, we ran two illustrations here. The CalPERS, some of their letters talk about a 6-year benefit. That would be what you would take it down from a lifetime, and a $547,000 pool of benefits. That's roughly $250 a day. If you chose an option like that with no inflation growth at age 65, each insurance company sets its own rate, and so you can see here that we looked at the lowest price and the highest price company offering currently products in California. The price range is going to be from $4,200 to $8,200 a year for a single person. If you chose the 6-year benefit with the 5% annual inflation growth option, you can see it's going to be $10,000 to almost $20,000 a year. Does it pay to drop your coverage? No. Does it pay to take your time to switch? No. You're not going to find better coverage today for less money. You've got good coverage. You've been paying all of these years. Nobody can predict the future, yours or anybody's, but I would tell you that I believe that you can rest assured that what you've done is a good plan to protect your future. If you'd like more information on long-term care insurance, the American Association for Long-Term Care Insurance has a number of free consumer guides that are on our website. Or even if you know others who don't have insurance who are shopping around, this is a great place to start. The website's www.aaltci.org/guides. All of the information is there, obviously, for free. There's no sign-in required. It's accessible by anybody, and we encourage you to take the time to read or to recommend it to others. And of course, as I said, if you're a CalPERS member, requesting a quote will only frustrate you more and not serve your purpose, because I shared with you what costs are for a 65-year-old. They're only going to be significantly higher beyond that. But if you know others who are looking for long-term care insurance, I encourage you to have them fill out the no-obligation quote form, hear from an association member who will give them no-obligation costs and information. Thank you for taking the time to watch this presentation. I sure hope it was helpful to you.